We are now in the final week of the course. In this week, we will not introduce any new topics, but review all that we learned in the previous weeks against the course objectives that we defined before going into this course. The course objectives were the following. You will learn to create a financing structure that is optimal for the success of the project financing, and this includes creating an optimal allocation of the risks, reward and roles between the various project stakeholders to support the project financing, create a financial risk management plan, and constructing the optimal legal conditions for a project financing to succeed. First, let's look at the first sub-objective, optimal allocations. Allocation of the project rewards. Optimal allocation of financial rewards was addressed in the financial section in week 1. We saw that investors and lenders have specific requirements when it comes to their share of the project cash flows. They need to be able to identify at least a certain level of financial return before they will invest. If we are to succeed funding in our project, we will need the project to offer them at least that financial return. In week 5, we saw that we use a project model to generate and analyze these cash flows. That model also enables them to analyze what the financial consequence of risks is for their returns, applying sensitivity analysis. In addition to financial rewards, the project may bring other non-financial rewards, social returns such as poverty alleviation, less traffic congestion or lower CO2 emissions, etc. We saw that private financial investors will not normally be able to value such social returns very easily. If we aim to optimize the allocation of the project rewards, these rewards may better be offered to public stakeholders, such as government that provides a concession for a PPP project. We saw in week 4 that the concession agreement in a PPP is the perfect document to allocate the various types of project rewards between the groups of stakeholders. Now we look at the optimum allocation of the project risks. In principle, all the risks start off being for our project company, as it is the entity undertaking the project. And thus the investors in and lenders to the project company will also bear those risks. Week 1 taught us that. If we leave it at that situation, they may not provide the funding we need. Or even if they do, they are likely to charge us extra funding rates that may be higher than the project can bear. We saw in week 2 that we try to manage the risks by allocating them away from the project company as much as possible. When we do this with a risk management plan, where we identify risks and then try to allocate these risks away from the project company and the financiers in a contracting structure and through insurances. If we allocate a project risk to the party who is best able to manage and control that risk, they will be a reliable counterparty and charge the project company the lowest price for their risk mitigation. We allocate construction risk to construction companies, interest risk to banks, etc. So the optimal risk management plan is a plan where we have allocated risk to the most appropriate stakeholders as much as possible, reducing the funding cost to the lowest level possible and the allocation bringing the project company the greatest value for money. Once again, the project model enables us to quantify these factors. The optimal allocation of roles in a project finance will be the allocation where each party has a clearly defined role and a clear responsibility. Also, the area of responsibility must be that party's core competence, in which it has a proven track record. For example, construction conducted by a proven EPC contractor, operation and maintenance according to clearly defined minimum standards and again by a proven contractor. Project sales to a professional off-taker with market knowledge and a successful track record, say a power company. And finally, management of the actual project cash flows is also a role we should take care of. We saw that these flow according to a pre-agreed sequence, the payment waterfall or payment cascade. and that they flow through a bank that has experience in monitoring project cash flows. With this allocation of roles and risk, we have created a clear governance structure. And the financiers can be confident that that role has the highest chance of being carried out successfully and efficiently. And if not, the responsible contractor will be fully and financially motivated to remedy a problem quickly through the contractual arrangements. That leaves the final objective: constructing the optimal legal conditions for the project to succeed. The legal conditions that we seek are the ones that lay down the governance structure, the optimal allocation of rewards, risks, roles, and responsibilities. Essentially, the contracting system needs to enforce all that we identified just now. With many years of project experience, a standardized contracting system has developed that we can tap into when we develop our project. The standardized contracting system helps us think through the various issues, identify potential solutions, and document them in a way that has proven its worth over the years. All in all, it may seem a lot of effort to work through all these issues in the early stages of project development, but doing so will greatly aid the funding and also the project success after closing. The case study we use to illustrate the course topics is a civil construction project. That connects well with our faculty at Delft Technical University, the university that develops this course. I saw that quite a few of the registered participants work in areas that focus on smaller scale projects, for example solar panels and other forms of sustainable energy projects. You may be wondering if all this applies to your projects too, given the cost and hassle that a full-scale project finance it brings to the project preparation. As an investment manager in a fund that invests into sustainable energy deals, I can confirm that the same principles are applied here, albeit that we of course try to tailor the requirements to the size and complexity of the transaction. But in these smaller deals also, offtake agreements, EPC construction and ongoing product guarantees are vital for the funding. Because the returns generated by the new energy technologies are still relatively inefficient, risk management and contracting are particularly vital here too. This video concludes our course. The remainder of week 6 is to enable you to catch up in workload. I hope that you enjoyed taking this course as much as I enjoyed preparing it. I tried to make the course practical, hoping that you will recognize the situations and issues that we covered from our daily practice. Finally, I welcome your reviews and I'm open to suggestions for improvement of this course for the future. Together with Emiel Peters, I thank you for all your hard work in this course. We hope that someday our paths will cross. Perhaps in questions you have for us through other professional trainings that we give, the courses on the TU Delft, or through an investment from the funds that Emiel represents. National Groen Fonds, the Natural Green Fund in the Netherlands. All the best.